Staub here, back again with another segment of our pre-work series into the webinar. If you've been following each webinar, you've seen us go through a number of techniques in analyzing deals and metros and speaking to the concept of how to get to be a millionaire within real estate. But now today, this is if there's one thing that you take away from this pre-work, this is the one. Okay. Today we'll be talking about a ratio, potentially the king or queen of all ratios within real estate, and it's called the debt coverage ratio, or in corporate finance, it's known as the debt service coverage ratio. Okay, and what this ratio is, it's a measure for a company's ability, a commercial project's ability, a residential investment's ability to cover the operating expenses. Okay. Now, if you think about this in its relevance right now with the COVID-19, a downturn in the economy could mean that your tenants need to either reduce their rent by moving out or you lower it for them. And at the same time, your operating expenses usually stay flat. So now if you're one of the unfortunate investors that bought on the hopes of appreciation and not cash flow, then you're already in a situation where this ratio would look not so promising for you. So, which again is why the pros that I know myself only buy properties that have cash flow from day one. But anyways, this ratio, I'm going to walk you through here in a second, but it's really the guide that I use for a double check on all my deals. First I'll look at a metro and analyze where I want to be. Then I'll measure the deal in terms of the potential returns. But before I do anything, I make sure that my debt coverage ratio is at least a 1.2. And I'll explain what that means here in a second. Okay, so I'm going to share a screen and walk you through the debt coverage ratio. So if you recall, this is the worksheet that we use as we explain how to get to become a millionaire in real estate. And today, we're going to be talking about debt service coverage ratio or debt ratio or debt coverage ratio. So again, are the exact same numbers as our last segment. Nothing has changed here. Everything's the exact same. But what I want to do is I want to walk you through how to get to this right here. Now we know from our last segment that, rents are rents. So when you look at the basic P&L of a property, you have your rents and then you have your operating expenses, your mortgage, property tax, property management, insurance, maintenance, vacancy allowance. And the difference of those two, hopefully it's a positive, is your monthly or your net operating income. And as you can see here in the DSCR calculation here, debt service coverage ratio, it is month or net operating income divided into your debt service. And in that case, that would be mortgage. Now, this is the traditional corporate way of looking at debt coverage ratio, but in my opinion, it's different in real estate because it's not as simple as net income paying your obligations. It's far different. The way that I look at it in real estate is to say, okay, well, yes, it is still the method of debt coverage ratio, but what will be known as debt in this math here, or total debt service, becomes just operating expenses, right? So that's going to be, and I include mortgage in that. Some people don't include mortgage. I include mortgage. So basically your mortgage, right? Plus property tax, plus property management, plus insurance, plus maintenance, plus vacancy. I include everything. And I said, okay, well, I know that per month, in the equation, debt service or really operating expenses are $944. So you have to make in rents $944 per month to break even. And so the current rents are $1,200. So the math in this case, still the same concept, but it's actually the rents divided into the net operating expenses. And you can see that this deal would meet my threshold of the 1.2. So that's how we get, and down here I have that marked as well. You can see my benchmarks. And so that's how you get to the debt coverage ratio. It's not technically, again, debt coverage ratio, but think of it as that as you're doing your math, Okay, so again, rents divided by the operating expenses gets you into your real estate debt coverage ratio. Okay. Now, why does this matter? Well, let's paint a what if. Let's say your tenant runs into a problem. They're not able to pay this $1,200 a month, and they say, "Hey, Joe Smith, or whatever your name may be, I need to lower this rent if I can stay here." Again, you don't want a tenant to turn over unless they're a bad tenant. You want to keep them in there. So maybe you give them some relief for a few months, and you say, "Okay, well, I'll reduce your rent by $200." Okay. So $1,000, you're still cash flowing, right? $85, and they're able to get relief, and your tenant stays in the property. Now, obviously, after those 2 months, you would increase that back to the $1,200, and everything's great. Now, so what would happen if you had let's say a 1.05 debt coverage ratio in this case, right? So what would that be? It would be like 960. So let's say that your rents were 950, your operating expenses were 944. Well, yeah. Now, if you have to take a downturn, hit to your rent, you don't have any flexibility. You have $43 of room to reduce your rents. Not only this, but if your maintenance all of a sudden goes up 1 month, you're also down to the red. If your property taxes go up and you can't raise your rents, you're probably in the red. My point is this: having a debt coverage ratio of 1.2 or higher gives you the flexibility to move around numbers and still cash flow in the worst case scenario. Below a 1.2 debt service coverage ratio, you're often not able to cash flow when situations like the downturn or maintenance or whatever happens occur. Okay, so the benchmark that I tell my clients to use, that I personally use, is 1.2. Okay. Now, there are two other metrics I'll explain here, and then we'll wrap this up. Capitalization rate. You'll hear a lot of investors talk about cap rates. Cap rates are essentially just your return on investment, assuming that you bought all cash. So there's no mortgage, right? So pretty basic there. Cash on cash ROI. This is really what matters. Essentially, it's the return, or your monthly cash flow, or really your annual cash flow, divided into the amount of capital that you invested in that project. So you can see the benchmarks. I think in today's market, cap rates are around, if you're getting a decent deal, around 7. I think for levered properties that use loans or cash on cash ROI, 10 to the upside 13% would be a good number. Okay. So again, debt coverage ratio in real estate is the king of KPIs. The main target is 1.2. So hope you enjoyed. Look for the next segment coming your way soon.